Hey, good morning, everyone. I just want to talk very quickly about Gigacloud Technology. It's a company I'm very bullish on, and I've started adding to this position for the first time last week, and I'm going to be building up to 10% of my portfolio. So I basically want to give like a quick TLDR of what this business does and why it's cheap. So Gigacloud Technology is a B2B business. They basically help sell furniture from manufacturers in China to distributors in Europe and United States. So like little stores that want to sell furniture. Okay, they're not B2C, so they don't compete with Amazon. That's kind of common misconfusion. Now they are a Chinese company. They've relocated their headquarters to the United States, so they are basically technically more of an American company now. But a lot of the back office is still in China. Okay, so there's been multiple short reports on this company because they're basically kind of an easy target, right? If you have explosive growth and you have explosive growth in kind of a weird industry like furniture, and you have the accounting are all Chinese, like it's a Chinese accounting firm, that is why it's very easy. Like it basically seems like it could be fraudulent. So a number of short reports came out about the company, and it was shorted twice, and you can actually see. I think the first one was like back in 2023, but you can actually see this the one that happened in 2024 happened like right here. And since it is continue to trend downward. Now, what I find very interesting about this business is you actually go to Q3 and the year over year growth was like 70%. And if we actually look like basically everything on a trailing 12-month basis, right, a quarterly basis, we can see that their net income has actually been going up like very nicely, and it's now at 130 million run rate. And if we were to look at cash flow as well, on a trailing 12-month basis. A little bit more inconsistent, but we can see it's like exceeded $100 million in free cash flow. And if you look at the price of the business today, $765 million, if they were to just start buying back shares, they can buy back the entire business over the next 7 years. And on top of all of this, they have a very strong balance sheet as well. So you look at the total cash position, it's up to 250 million. Now it's like literally a fortress balance sheet. One third of the market cap is just their cash, right? So you think about the enterprise value, it's like a $500 million company based on enterprise value. So they could easily buy the business. I said 7 years, they could easily buy back the entire business in the next 5 years. If you're going to be buying Gigacloud Technology, you basically have to be buying it whether or not you think it's fraudulent or not. I'm going to link an interview with the CEO on Seeking Alpha where they kind of go through a lot of the short report that does a good job of explaining a lot of the main concerns. But I'm going to address some of those here very quickly. The first thing that people bring up is like a lot of insider selling. I think sometimes with stuff like this, people have to remember, this company was founded like 20 years ago or something. And for the most of the lifetime of this business, it hasn't been a publicly traded company. So if you're the CEO of a company, the only time that you can take money off the table is in funding rounds, right? And of course, if you're raising funding rounds, it's not like a good look either if you're selling a lot of the business sometimes. So if you want to get the most in a funding round, you're not always like selling significant amount of your net worth in the funding round. And if you think about it, even this way, like at this point, right, they went from $4 a share here in 2023. In a year later, dude, they're at $40 a share. So the CEO, as well as many insiders, literally would have seen their net worth 10x over the course of a year. You think about how hard it is to hold any position that 2x's. Imagine holding a position that's your entire net worth at 10x's. Even though the business was still, I think there's fair value around here, but maybe on the cheaper end. Even though that was true here in 2024, right? You can understand why they'd want to sell shares. Like it, and a lot for some of them, it was like venture capitalists were just selling their entire position, right? Which makes sense. You're in the business of VC, not publicly trading stocks. For the CEO, he sold 10% of his net worth to diversify. That was his reasoning, and that makes sense to me. That's not a hard thing for me to understand. I, in general, have never like taken insider selling to mean that much. Even if the intrinsic value of the business, which by the way, I think $40 is pretty reasonable, right? Maybe like 50 is very quite close. Even if it's below intrinsic value of the business, it can take a while for the market to realize that. So it's not hard for me to understand why someone would want to take advantage of just taking some money off the table, having some cash in reserves, and diversifying their net worth a little bit. And the majority of the CEO's net worth is still in this. So generally, like insider selling, it doesn't mean too much to me. Other concerns was like the Chinese accounting firm. What the CEO says about this, and it makes a lot of sense. He's like, the G&A expense would increase 20% if we brought this to the United States. So the business would actually become less profitable. And from his view, he's like, this would obviously have an immediate effect on the stock price. That's true. But he also said, you know, if we are legitimate, it's going to, it will be obvious in a year or two, right? If people understand that. So he's like, I can achieve the same thing without spending more money. So he's like, from a long-term shareholder perspective, it's actually better to not do this. And I actually agree. From a long-term perspective, all that has to change is the narrative on the business will change. And the narrative for the business will change as long as they continue to execute. So that's just like that's why I'm not really worried about the accounting stuff. In terms of like the numbers and business legit, I think it's very legit. And mostly because if you go, and I'll link some more of these articles on Seeking Alpha, people have gone in these warehouses and they are huge and they're just filled with items everywhere, right? It's a very hard thing to fake. Now, what made me start becoming a buyer is actually very easy. And I just want to like basically give the quick investment thesis here. If we go back here, okay, they initiated a share repurchase program at the beginning of Q4. Okay, they announced it in Q3, but they started in Q4. And by the time that they announced their Q3 earnings, which was like a month into Q4, right, they had already spent $11.4 million. So they had spent 25% of the share repurchase program in a month. Right? So this was announced for a year and they spent 25% of the share program in a month. So what's going to happen is they will probably, because it's cheaper now, the stock's cheaper now than when they announced this, it will probably complete this, right, by Q4 earnings. And what I kind of expect in Q4 earnings is they will announce a new share repurchase program, right? If they're conservative, they'll do $50 million. But the way they did this program is they did this based on the excess operating cash flow they had from 2023. So their excess operating cash flow in 2024 is massive because they made a bunch of acquisitions in 2023. They didn't make any in 2024. So their operating cash flow in 2024 is like $100 million. So I would not be surprised at all to see a $100 million share repurchase program announced after Q4 earnings. And if we think about it today, right, we'll just make it easy. It'll be 1/8 of the business, which is 12% of the business, excluding the current share repurchase program. So as a shareholder, what you will get in the next year is essentially 12% increase in EPS if they maintain their business. Now, this is like one of the most important things because either the share price is going to move or they're going to buy back the entire company. I actually don't care. If they buy back the entire company, I'm not selling my shares, right? Which means at some point, if they buy back the entire company, they could just pay me like the biggest dividend of my life. Now, what's going to happen is the share price will start to move, obviously. But the last thing I want to point out here is their margins. I want to talk about these. So one of the reasons why people are a little bit concerned with the business is they've seen this explosive revenue growth, okay? But their earnings have been really inconsistent. So if you look at this, like your revenue's up like 70% year over year. And this is actually a 70% increase in income. But for 120 million increase in revenue, you only did 16 million in earnings. Like it's not that exciting. But part of the reason why is because they bought Noble House. And when they bought Noble House, okay, they said it wouldn't be profitable until 2025, basically. So a lot of this revenue is not profitable in that, right? They're basically taking short-term losses as they integrate this other furniture business into their company. So what we're going to see in 2025, even if revenue doesn't increase a lot, which it won't probably increase as much because a good amount of this increase is from Noble House. What we're going to see is expansion of margins. So we're going to see a stabilization in earnings. We're going to see expansion of earnings just because this business they acquired is going to become profitable in 2025, and we'll probably see peak expansion in 2026. Now, some of the other things I'm pretty excited about, and I don't know if we can even see this here in these KPIs, perhaps not, but they're showing really strong growth in their European business, right? And they're showing very strong growth in their 3P business, which is third-party service. So Gigacloud does two things, okay? They sell their own products, but they also help people sell their products, and they manage that for them, okay? So if you're a 30-parter, like let's say you're a furniture company, it's really expensive to run a warehouse and to manage the logistics, and they do all that for you if you want. You don't have to, right? So that's basically what the third-party business is, getting sellers and matching them to buyers and managing all the logistics of the business. It's also one of the reasons why I realize it's a much better business than I realized. Logistics is really, really hard. It's one of the hardest things you can do and do well. From like a computer science problem, it would be like an MP kind of problem, I think. But if you look at one of the key metrics I want to point out here is if you look at the active buyers and the active sellers, they've been increasing quite aggressively, right? I mean, we go back here a year ago, right? Not quite 100% year over year, but not far off. And if this part of your business, the active buyers and active sellers, is increasing, you're going to see it flow down to revenue, right? some these things are always going to be lagging a little bit because as a buyer, I'm not going to reach my full maturity um, when I first start out, right? And this is true for any customer, right? Customers take a year or two to reach full maturity in the revenue contribution. So the most important metrics I think when watching this business is we want to see these continue to trend upward, and we can actually see this spend per active buyer. This is 145. It's been going down, and why has it been going down? Is because their buyers have been increasing so aggressively. So it's actually a good thing, right? You might be thinking it's a bad thing. It's a good thing. This will retrend upward when this number eventually slows down. So just in general, I strongly believe the business is legit. I believe the share buybacks will drive the share price regardless of what the market does. And I think this business, I think it will grow actually pretty nicely. I think it will continue to grow like 10 or 20% annually. I think it has that runway. They have something like 2% of the total addressable market of what they're targeting. So, could they reach 10 or 20%? I don't know. But it does mean that there's plenty of room for them to grow, even if they don't get 10%, right? If they grow 15% annually for the next 5 years, that would take them from 2 to 4%, which means at 4%, there's still plenty of room to grow. So I actually think in general, like it's very cheap. It's very opportunity business. And I also will say, I think this is 2X opportunity. My guess is this company 2Xs in the next year or two. Like, I just don't see how it doesn't happen. If they maintain their cash flow, they just have to maintain their business. They don't have to do anything else. And if they can maintain cash flow with like 15% growth, it will double 100%. So yeah, I'm investing very heavily. We'll see how things go in Q4 earnings. And I guess the last thing I point out is a lot of the insider selling trailed off quite heavily when they started getting down to these cheaper prices. And there's a reason for that because this is way below intrinsic value in the business. So yeah, just some quick thoughts on Gigacloud Technology, why I'm a buyer. I'll do an update after Q4 earnings, and yeah, have a great day.